Hey everyone, I wanted to talk to you today about our partner company, Top Producer Investment Capital here. Now, this group is made for loan officers and realtors because I used to be a mortgage loan officer and I worked a ton of hours to grow my business. And I definitely realized that the highest potential of me as a loan officer was closing more deals. I also understood the benefits of investing in real estate. And so I did purchase some investment real estate along the way. It was good, but I would see other people who were full-time investors making more money because they were full-time in the business. They had access to the best deals. They had time to crowdsource deals coming in. They had time to find a good process and a good flow. The work that they were being done on them was of a higher quality because they could pay more attention to it. They had better labor, they had better talent, they had better design, and they just spent more time learning more about it. So I was always envious that these investors got to make more money investing in real estate than I was making, even though I worked in real estate and I understood it. I just never had the time to do it. And to take the time to learn to do it would be taking away time from me as a mortgage loan officer. And I know this is the same for top agents as well. You sell $1 million homes, and that's where you make your most money is on these commissions. And you probably have access to see some good deals, but taking the time to invest, negotiate, design, renovate, I mean, that's outside of the skill set of being a top producing realtor. So it goes both ways. The point of this is real estate investing should be profitable, simple, passive, and that you can focus on closing more deals because that is your highest dollar activity that you should be doing. So I'm going to start off with Dave. Dave is an amalgamation of what a lot of loan officers are going through these days, what I was doing as a loan officer as well. So I relate to this. So Dave, let's talk about him for a little bit. He's a branch manager at a mortgage company. He has a team of sales agents underneath him. Last year was a great year. He had $40 million of transactions sold. Now, that may change from one year to the next, but I mean, he is still a top producer and he has time to lead agents underneath him. Now, he's got $1 million to invest because he's been a branch manager and a loan officer for quite a while. And so he's invested his $1 million of equity into 20 single family homes. He saw them on the MLS. He put 20% down. They were good houses in good areas. Some of them cash flowed a little bit, but he's buying them because he's got a lot of money and he knows real estate's a good investment. So he is buying single family real estate. He also knows that a lot of contractors just kind of rip them off, and even property managers just pay top dollar. So he has some property managers, but he tries to subcontract the maintenance to keep expenses low. That does take a little bit of time. He has to go out there every now and then and just make sure the contractors are doing good work, or even that the property manager is keeping rents where they need to be. It's a bit of a part-time job just to kind of check in on your real estate investments. You can never have them completely be passive, even if you have property managers. So now here's the thing. Dave's a smart guy and he's grown his loan officer business by delegating. He is good at bringing customers in the door and closing the sale and recommending mortgage loan products and leading a sales team. But he would not be able to do that efficiently if he had to do every step of the process. So he has a marketing assistant. He has a transaction processor. He's got a closing coordinator. He's got a sales team, tech support, reception. He's got all of these pieces of the puzzle that he's working with him to help him close more deals so that he can narrowly focus on his highest dollar production activity. So Dave understands the benefits of delegation here, and he is maximizing his delegation. So because of this, you can see, obviously, it makes sense that over time, Dave's business has grown, and he is a top producer because he's crushing his sales because that's what his master's skill is. So let's take a closer look at what exactly Dave is doing. We had talked about he closed $40 million of loans. He leads a team of sales agents. He owns 20 single family homes, and he also subcontracts the maintenance out. So let's see, like dollars, what does that mean? Dave gets paid 1.5% on every loan he closes, or 150 bips. So 40 million in transactions last year means $600,000 of profit. But I mean, he is full time, so he works 1,200 hours a year doing this. So it comes out to be about $500 an hour. Now, he also leads a team of sales agents, and that doesn't make as much as his closed deals, but it's great and it's a passive. He only had to work 800 hours a year, and a lot of that was mentorship. But as he grows, he'll be able to spend less and less time generating more and more sales agents and generating more and more profit with less hours. So even though he's making $250 an hour doing this right now, over time, it is going to scale and it is going to go up. Now, Dave also had his $1 million of equity invested in these 20 single family homes. Last year, he got $50,000 in profit. Now, he had to work 250 hours a year on this. And that comes in the form of identifying a property that he wants to purchase, going and touring the property, having an inspection, working with the bank, getting an appraisal, after closing, making sure the tenants are in there, property management set up, utilities are all turned on. There's a lot of pieces to this puzzle. And as he gets better, he is going to be a little more efficient at it, but it is part-time. He does still have to work 250 hours a week. And if we kind of break that down, that really comes down to about 5 hours a week. So it's not a ton of time every week that he's doing to this, but it adds up over the course of a whole year, 250 hours. So he still is making, quite a bit of money, but it's not passive. It's a $200 an hour task that he's doing in order to make this $50,000 in profit. Now, over time, real estate's going to appreciate. Maybe he can get some processes streamlined, get a little more efficient, but it never really goes to zero. And then lastly, he subcontracts maintenance. Now, you guys already know the formula. This is going to be his lowest dollar per hour activity. He's still making $100 an hour doing this because he's saving $10,000 a year. And let's say, this is $10,000 of savings compared to if he were to just have the property manager sub everything out, or if he were to have a contractor do all of his renovations instead of having the property manager manage some of it. So it kind of comes in pieces, but it's an amalgamation of saying he basically saved $10,000 by not overpaying other contractors because he was in the weeds and helping out. But of course, this is only a $100 an hour task. So we add all this up. He made $860,000 last year. Not a bad paycheck by any means. He's definitely in the top 1% of people, in the US and, possibly even in the mortgage industry here. But he worked 45 hours a week, and that's kind of standard. I know some loan officers are 50, 60, maybe even 70 hours a week. Hopefully the goal is to kind of keep it around 45. So this is more of an ideal of what we're all trying to get to. So now let's meet Greg. Greg is also a branch manager of a mortgage company. He has a team of sales agents as well. And he was able to close $75 million in transactions. Now, Greg and Dave have been working about the same amount of time in their careers. So Greg's gotten a little bit further, and we'll kind of look into this as well. Now, Greg also knows that investing in real estate is a great way to go. And he passively invests in commercial real estate syndications. He's not buying any of his own single-family homes. He's not managing any of the maintenance. He is just passively investing his money in these syndications. He also has $1 million to invest. So let's see how that turns out. Greg also understands the benefits of delegation. He also has all these same teammates helping him close all of these deals: the marketing assistant, the transaction processor, the closing coordinator, and sales team, tech support, and receptions. The additional team member that he's got is top producer investment capital. Now, the reason that he added this to his team is just an extension to allow him to focus on, again, what he is highest and best at, which is closing deals, getting customers in the door and closing the sale and building the sales pipeline funnel so that he can close more mortgage loans. Trying to also invest and be an investor part-time when your highest dollar per hour skill set is closing mortgage loans is a waste of his time. It's something someone else really should be delegated to do. So let's see how that breaks out. Last year, he made $75 million in transactions. He closed $75 million in transactions. He had to work 1,400 hours a week. So he had to work more, but he had more time to do it. So he got $1.1 million in profit from that. $800 an hour. He also has to lead a team of sales agents, and they made $300,000 of profit. He had to put more time into it. He spent 900 hours last year instead of 800, but he was able to get more profit from that because he's able to focus his energy. And even though he spent more time, that time was more focused that he was doing it. So he gets $300 an hour for that one. And then lastly, he's invested in syndications. He invested that same $1 million equity check, and he got a 20% return on his money. So he actually made $200,000 in profits. Now, this looks like it could be a lot of work, but it only took him 25 hours a year. And the reason for that is because he partners with Top Producer Investment Capital Group. We are the experts. We will find the best deals to invest in. We contact owners directly, and we negotiate a price that's below market so we can get in already with profit and equity built into a property. Then we've studied how to maximize design, maximize profitability, maximize efficiency in the construction process to save on costs and increase revenue as high as it can go. And so because of that, we're able to get these substantial returns on these properties because we're maximizing every part of the process. And then lastly, what we do is we bring these investments to the top producers in the group and allow them access to be a part of these deals. For instance, we're raising $3 million on a property. So we need a $3 million down payment. And as much as we'd love to do that all ourselves, we want to partner with agents, brokers, and lenders, top producers in their area, to come in and do these deals with us so that we can all share this wealth. and offer, 15 to 20% rate of returns on these deals. You're not having to do the work of marketing, finding a deal, going under contract, putting your earnest money up, working with the realtor, having the contract fall out. That's all our job. We do all of that for you, so that the only thing that you need to do is review this deal and decide what level of investment you want to partner with us on, and then help us maximize these profits and take down these extremely profitable, well-run deals. So because of that, it's an $8,000 per hour task if we divide $200,000 in profits to 25 hours a year. Now, a lot of people are going to say he made more money investing in the syndications, $200,000, than he did with the $50,000 profit that Dave got. And here's the difference, is because these syndications are maximized in their efficiency. They spit off 20% average annual return profits. We're finding the deals that are going to be the best to buy and the best to sell at the best time with the best rate and the maximized efficiencies. Dave is buying 20 homes. They're each profiting $200 a month. And he had $1 million of capital. He bought these 20 homes for $250,000. He put 20% down in each one of them. So that adds up to be $1 million of equity invested. Each home is spitting off $200 a month in cash flow. That's after mortgage payments. That's after repairs. That's at taxes, insurance, property management fees, everything. It's $200 in his pocket at the end of the month. Over 20 properties, that ends up being $50,000 compared to a $200,000 profit. And this only took 25 hours a year, because all you're doing is really reviewing the work that we've already done and saying how much you want to come in for. So this ends up being an $8,000 an hour task, just because you had $1 million to invest. And the more money you have to invest, it's only going to take you 25 hours a year. So if you end up investing $2 million and get $400,000 in profit, you're going to be at $16,000 an hour. One of the highest paid people out there, because you're only having to put a little bit of time in there. And the point of this is, let us focus on maximizing this potential, so you can focus on maximizing these two potentials up here and make the most amount of money possible. So you see this guy, Greg here, made $1.6 million last year for all working the same 45 hours a week. And the only difference is he spent his time investing in syndications, partnering with the experts, so that he could focus on his highest and best skill, which is closing more deals. So who's going to be a top producer? Obviously, both of these guys are top producers, Dave and Greg. But if you put them back to back together, Greg just has more time and more focus to do the same things that drive more dollars. So he's going to be able to be a higher top producer, because he's partnering with the people that are helping him take away the things that are not his highest and best use. So here's a couple other things about top producer investment capital and why our investors and top producers choose to work with us. Typical $200,000 investment in our syndications will receive typically 40% tax benefit. So you could get $60,000 to $100,000 deduction right off the same year that you invest. Next, the velocity of money. And this goes into the bigger phase of why we invest in real estate deals, is because as a loan officer, as a realtor, you can still maximize your time, but you're always going to be capped to some extent to how many deals that you can close. And you can make a lot of money. You can make $1 million a year as a loan officer, but you're still capped on how many deals you can close and how many closings you can put into the system. Multifamily apartments are massive, and you can invest in tons of them at the same time. So as your net worth grows, your income from your investments is going to grow. And then lastly, that leads to our final point, which is financial freedom beyond the office. Because, working as a mortgage loan officer, a realtor is great. You're crushing it. You're making a ton of money. It's a tough gig, and you want to have time for family. You want to have time for fun and kids and everything outside of the office. So you want to be able to work when you want to work and on the things that you want to work. And maybe one day you want to retire, or maybe you want to, do something else. This investing strategy gives you the freedom to be able to continue to have truly passive income coming in the door every quarter, every year, even after you leave the office. So you don't have to worry about that income going away, because your net worth is growing over time with these investments. A little bit about us. We invest in high return multifamily apartments. And there's a lot of reasons for that. Economies of scale. Basically, if you have 100 single family homes spread across the US or even Texas, you're going to have lots of different property managers, and the property manager can have to drive between all the different properties, and they're going to be focused on other people's properties as well as yours. Economies of scale means we put all 100 units right next to each other. We have one manager managing all of them. We have one maintenance guy maintaining all of them. And they're going to know that property inside and out. Everything's going to be replicatable. You're not going to have 100 different sinks that have 100 different faucets that need to be replaced and go to Home Depot and figure out that, oh, this sink is a little different. I got to go run back there and get a different part. We have a warehouse full of parts that are sitting right on the property that when something breaks, we can go in there right away and fix it. Apartments are recession resistant because if inflation goes up, rents will go up, values of property goes up. It's because it is recession resistant. So if someone's living in an A-class top building and they're paying high rent and a recession hits and they lose their job, they're just going to knock down to the B class tier and they're just going to stay in an apartment that's a little bit cheaper, but still serves the same thing. And that's right where we are. So even if the people that we're serving right now have to move out, the people that are above them that are moving down are going to move into our units. So we are recession resistant from those two standpoints. We have cash flow. So unlike other investments like the stock market, which constantly is going up and down and may pay some dividends, but you have no control over it, these investments are based on tenants. They have cash coming in every single month. We do upgrades, we do renovations, we buy right so that profits can go up over time. But we also have cash coming in the door so that every quarter, every year, you're getting that standard 6, 7, 8% on your money as the money comes in. So even if the market is up or down, you're still having rental income coming in. We've also got market appreciation, which we all know real estate appreciates over time. Market is in cycles. It does go up and down over time. There may be a slight shift in the near future, values that could go down a little bit over time, but it also opens up an opportunity to get some properties at a really good discount, a really good deal, and buy at the right time. But over time, these properties appreciate in value. So there's market appreciation and then there's forced appreciation where we go in and we upgrade the property and we have better customer service and we're able to charge higher rents and higher revenue. There's also stability and predictability. Unlike other investments, you don't know what the stock market's going to do from one day to the next. A bad news article comes out, the whole economy could tank from a stock market perspective. If you invest in another friend's startup, you really don't have any control or idea if that startup is going to go well or not. Real estate is good. It's predictable. With multifamily, you have lots of tenants that are all paying rent. So if you have a house and that one tenant moves out, you immediately lost all of your profit. But if you have a multifamily apartments, you have 100 unit, one unit tenant moves out or 10 tenants move out, you don't have to worry because you constantly have a stream of new applications coming in and you constantly have people filling those vacancies and you still have rent coming in from the 90% of other units to offset all of your expenses and your payments. So you're never really going to be at a loss. And then lastly, we've got tax advantages that we had talked about above. Cost segregation analysis on these big properties allows us to accelerate the depreciation and pass those along to our investors. What are the investments that you could be a part of? These are what we've done in the past, and we'll have more of these constantly coming out. So just be ready for when the next one comes up so you can take advantage and be a part of it. This is Harmony Village. This was the first one we did. Excellent property. It's a 32 unit property built in 1980. We bought it at a great discount at 1.7 million. We're raising the value to 2.9 million. There was one actually just down the street that was 26 units that's selling on the market for 3 million right now. And we've got 32 units and ours are bigger and 2 bedrooms. And so hopefully that value of 2.9 is even conservative. So the way that we're able to know what the value is when we do it is because these are traded at a cap rate. This is in a smaller town in Gonzales, which typically trades at a 6% cap rate. So if we raise this net operating income from $60,000 up to $175,000, that means that we're taking the value at a 6 cap from $175,000 means a $2.9 million valuation on this property. And we expect to have that NOI year 2. At that point, we're going to refinance. We're going to give the investors back all of their money. And then we're going to keep operating the property, driving 6, 7, 8% cash on cash returns after we've refunded the investors all their money from a cash out refinance. This one's great. It spits off a 17% internal rate of return, which is basically the rate of return you're going to get if the money's compounding year over year, similar to how the growth would be from a stock market. But you get an average annual return of 23%, which basically means this is a 5-year investment. If you take the entire profit, which is a 2.1 equity multiple, divide that by 5 years, that's a 23% return every year. Internal rate of return expresses that as if the money is compounding on itself every year. Average annual return is if you basically divide the total profit by 5 years, 23% increase per year. So $100,000 investment invested year 1 means that over time you'll get some cash flow, and when we finally sell the property year 5, you're going to get $110,000 profit. So your initial $100,000 turns into $210,000. That's what we mean when we say equity multiple. Here's the next one. Next is urban living in San Antonio. Antonio. This is a 75 unit property. The value is going from 6.8 million all the way up to 12.3 million. And the way we know that is because it trades on a cap rate. This one we're expecting to trade on a 6% cap rate as well. The net operating income is going from 287, which is where it is when we bought it. Because the seller wasn't running it as efficiently as they could, we're going to maximize it based on how we see other properties in the area working, all the way up to $668,000 by year 3. Now, this one has a 17.6% internal rate of return, another average return of 23%. You're going to get 2.15 times your money on this one. So another great deal, kind of right down the fairway of going in, buying it at the right price, financing it at the right price, and just kind of driving rents, driving the returns for the investors. And we do all the work on this. So you guys don't even have to lift a finger, kind of let us do all the work, and you guys get all the profits here. The next one we want to talk about is the Glamp Grounds of Canyon Lake. This is a 14 unit community that we're buying that's currently long-term rentals. We got it at a discount because we're buying it as long-term rentals and we're maximizing income. We're turning these into short-term rentals. So even though we're having this at a higher cap rate for short-term rentals, the value is going from 1.9 million all the way up to 5.1 million. We're taking the revenue from 83,000 net operating income up to $427,000 because you can get far more profit as short-term rentals than you can as long-term rentals. And these are unique. A lot of people would ask, well, why don't you do this with every property, turn everything into a short-term rental? And it just doesn't make sense for a 75 unit apartment building. It's unlikely that someone's going to want to rent that thing for like a week and pay top dollar and drive the revenue. But with these cabins, they're individual standing units. They have front yards, backyards. They've got this little patio. We're going to make them look really nice. We're going to build a community pool center. We're going to have a lot of outdoor games. All of these things are going to drive people to come and stay with us, and they're going to pay $300 a night, occupied 40% of the year. That's how we're going to get these 14 cabins to an NOI of $427,000 when the current owner is just, renting them out long term and not taking care of it the way you should. So this is one of my favorite investments, not because it's going to be a great project to work on, but the returns. You're getting a 20% internal rate of return, 25% average annual return, and you're going to get 3 times your money. Now, this is over a 10-year threshold instead of 5, but we return 100% of investor capital at the start of year 3 with a cash out refinance. So this one, you're going to get your money back, and then we're just going to hold it. And this is how you create generational wealth. Basically, on this one, you give us your $100,000. We give it back to you at the start of year 3, and then from then on, you have bought yourself an $8,000, $9,000 paycheck forever. So think about that for a second. How much money would you like to invest, or what's the cost of buying an $8,000 paycheck every year for the rest of your life? How much would you pay for that? If I said, hey, it only costs you $100,000 and I will give you an $8,000 paycheck for the rest of your life, is that worth it? Would you pay $100,000 for a $10,000 paycheck, a $15,000 or a $20,000 paycheck every year for the rest of your life? Especially knowing that I'm only borrowing it for 2 years and I'm giving it back to you at the start of year 3. So you're not even purchasing that paycheck. You're just renting it out. You still get your $100,000 back. And now you own this $8,000 paycheck that you're going to get for the rest of your life. An incredible investment. And this is how you build generational wealth. How many of these kind of deals do you need to purchase before you can just retire and have passive investments with somebody else, not only managing it, but running it? These are truly passive investments. They're going to hit your bank account every single quarter. You're going to have money coming in. You can decide to work if you want to or not. You can continue to grow your net worth every single year, and you can continue to benefit from the tax benefits and the depreciation and somebody else doing all of the work. This is why I love these investments so much. This is why I decided to get into this opportunity, because as a loan officer, I was frustrated that these opportunities were not being brought to us. And I was torn between having to spend my time growing my mortgage business and closing more deals and building out my mortgage team, which was my highest and best use, and collecting all of this money, which was just sitting there and it wasn't getting good use. And I was buying rental properties, but I knew there was a better way to do it. I was having to buy them off the MLS. I was having to put 20% down. I was having to have other people help do the renovations for me, and I was paying extra than I should. Some of the design and materials wasn't as good, and I was having to learn, and it was a lot of work and time that was just being taken away from me being a loan officer. And so that's why I'm so passionate and why I think these investments are incredible, because we do all the work. We're the experts. We're going to maximize the value out of each one of these properties. And we'd love to invite you as top producers to come take advantage of this opportunity with us so that you can continue to maximize your business and become an even higher top producer in your company and make work fun instead of having to stress about the investing side of business. So Thanks for joining us today. This is our investment club here. Click on this, subscribe to our content, join our investor club. And when you do, we'll let you know of any future opportunities that come up so that you can be part of our club and start enjoying the investing side of real estate again.